let's bring in Charu Chanana. She is the market strategist at Saxo Market. So Charu, just looking at the strength of the global economy and what that might mean for earnings, we have the world's two largest economies, flashing the economic downturn fears. What is that going to mean for corporates?
We already saw in the Q1 earnings that even though most of the companies were able to meet their top line estimates, the bottom line did look a bit stressed because of the cost pressures that are coming from the gains in commodity prices and supply chain pressures. Well, we do think that is going to get worse into Q2 because, China has remained in lockdowns for most of this, the second quarter as well, which means supply chains haven't eased really. And of course, for most part of the quarter, commodity prices have actually climbed further, both on the energy side as well as the food prices. So that's certainly going to weigh on the costs for companies. And we do think we are likely to see a host of misses in the Q2 earnings season, which again might mean that there is a lot more pain to come in the equity markets as well.
Right. So do you see further downside risks to Chinese markets?
So Chinese markets right now are coming off a very weak base. Even though we do see a risk of further lockdowns, which does mean that, the Chinese economy's demand side will remain pretty weak. But having said that, I think that China might be able to avoid citywide lockdowns that we've seen for most of April this year. They also have a very important political event later in the year, and they want to show some decent level of growth to end the year with. Keeping that in mind, I do think that lockdowns may remain more targeted now, which means that will lend some support to the consumer demand. And also on the regulation side easing side, they have been announcing measures which are targeted to the key sectors of the economy, such as housing, as well as now the tech regulation cloud is kind of behind us. With all that in mind, it does seem like there's room for some gains in the Chinese markets. Although in the medium term, I'll still be very cautious, because the regulation cloud is still hanging and it can hit any of the sectors at any time. So that's quite unpredictable.
Right. What about the metals complex, Charu? Because there is this ongoing rate hike narrative, concerns about the demand outlook. What is that going to mean for that complex?
Yes, absolutely. Because last week after we saw the Fed raising rates by 75 basis points, the expectation of a slowdown in the economic momentum have picked up substantially from there. So there's a growing room, and it wasn't just the Fed. There were other central banks joining the tightening race last week, including the most dovish Swiss National Bank. So as more and more of these central banks start to tighten their policies in a rapid way to kind of get over inflation, of course, the risk of a global slowdown is looking more material at this point, which means demand destruction is going to happen, and it first hits the metals side, certainly. The metals have also been majorly weighed down because of the lockdowns that we've been repeatedly seeing in China. And as I said earlier, we continue to see the risk of lockdowns remaining in China actually until next year. That means that the demand side weakness is weighing on the metal side. But having said that, again, the supply side isn't much better, and even the anticipation of a weakening demand hasn't meant a pickup in the inventory levels of the metals space. There's the supply side of the equation that we also have to keep in mind, which makes me think that the downside is rather short term for the metal side, and we may see a recovery at least once we start to see China coming out of the lockdowns in a more stable way.
Right, and those tight supply concerns might be the prevailing market force in determining where prices goes from here. But just very quickly before we round up this conversation, Charu, it's an environment of many risks, and you're advocating a defensive strategy. How exactly should investors go about that?
Of course, like you said correctly, I mean, equity markets, it's a very risky time with a double whammy. The Fed is tightening and, doing QT, quantitative tightening, which means a lot of liquidity is being drained out of the markets. But at the same time, now we have this added risk of a recession, which is also weighing on the investors' minds right now. So, of course, that means there will be a lot more pain to go for in the equity markets. I think investors should remember that positions taken in bear markets actually bear the most fruits in the long-term horizon. If you're looking at value stocks, it obviously is going to protect your portfolio, but also try to find the growth stocks and the right entry point for those when we're in a bear market, which will actually ensure a long-term return for your portfolios.
All right, Charu. Sounds like good advice. Thanks very much for sharing your insights with us, Charu Chanana, market strategist at Saxo Markets.